everyone, welcome to the webinar on the upcoming new contract, INE Containerized Freight Index, Europe Service Futures Contract. This is our first online webinar on this new contract. At the same time, offline seminars are going on in different cities in China. Please consult with your broker for more information. China's shipping industry is large, and Chinese enterprises rely greatly on container shipping for import and export. By 2022, China's shipping fleet capacity reached 350 million deadweight tons, ranking second in the world. 7 of the world's top 10 container ports are in China. For a long time, freight price fluctuated quite largely, which brought tremendous challenges to the normal operation of shipping-related enterprises. The demand for a transparent platform and a risk management tool for freight price gradually increased over time. Therefore, INE's new Freight Index Futures is an important financial innovation to help global shipping enterprises in price discovery, in risk management, and in resource allocation. So today, we are delighted to have 3 distinguished guests to give presentation on the spot market, on a new contract design, and on how to access China's futures market. My name is Yiping, Associate Director from Shanghai International Energy Exchange, and I will be the moderator today. So our first speaker is Mr. Simon INE, Senior Manager of Container Research at Drewry Maritime Research and Consulting Services. Simon has over 2 decades worth of experience covering the container shipping market and works within the Maritime Research Division. After graduation, he had a brief career in banking before joining liner shipping database, Compare Database. As a researcher, he then progressed to become a reporter and finally associate editor of sister company, American Shipper. He won the Seahorse Club Journalist of the Year in 2006. Simon joined Drewry in 2008 to work on a number of shipper-oriented reports, as well as contributing to consultancy projects. He is the editor of Drewry's flagship Container Forecaster report and the online Container Insight Weekly. So now I would like to pass the mic to Simon. Simon, please.
Okay, good morning or good day to everyone. As I said, my name is Simon INE, Senior Manager of Container Research at Drewry Shipping Consultants, where I've been employed for nearly 15 years now. Drewry is an independent company with no affiliations outside whatsoever. We have no vested interest in whether the market is up or down. It's simply our job to know where it currently stands and where it's likely heading. So today I'm going to present some of the history and the basic characteristics of container shipping, as well as providing Drewry's outlook on the market. Most of the slides you're going to see today are derived from our Container Forecaster report that provides subscribers with a rolling update on developments within the market, along with the key forecasts that are refreshed every month. Now let's start with some history. Containerization started life in the mid-20th century following the brainwave of Malcolm McLean, a US trucker, and it was quickly adopted worldwide due to the time and cost savings brought about by the key concept of standardization. It soon became an integral part of global trade, with container ships representing the most cost-efficient and often the only method of transporting large volumes of commodities around the world. The standard unit to measure volume or capacity in container shipping is the 20-foot equivalent unit, or TEU for short. Those containers carry a broad range of products like manufactured and consumer goods, chemicals, food and healthcare related products, among others. Think of something that you've bought recently and the chances are that it arrived via a container ship. And what you are looking at here is a history of global container throughput this century and our forecast through to 2027. Container trade has grown every year since the industry's inception, apart from two, that's in 2009 and 2020. So the market only really slows down for either global financial or health crises, and even then only very briefly. Back to basics, throughput is a measure of the level of activity of the container industry, and it's made up of three different traffic streams. That is loaded containers, empty containers, and transshipment. Transshipment is when full and empty containers are shipped between two regions via a third one. Global container throughput reached 862 million TEU in 2022, and we expect it to be added another further 125 million TEU by the end of 2027, based on our latest container forecaster prediction. The growth of container trade is primarily driven by the growth of economic output and consumption and changes in the patterns of world trade. Throughput grew at an average of 3.5 times that of global GDP growth from the year 2000 to 2010, and that was thanks to the production outsourcing of developed countries into developing economies and the uptake of containerization across the world. By the time of the global financial crisis in 2008 and 2009, outsourcing had run its course, and subsequently the GDP to TU multiplier slowed. We saw container throughput grow at an average of 1.5 times that of GDP from 2010 to 2020, and we expect it to slow even further, growing by a predicted average of about 1 times that of GDP growth from 2020 through to 2027. The full chain of container transportation consists of many different key elements and different players, from origin to destination across the entire end-to-end supply chain. These include the shipper, freight forwarder, shipping lines, port and terminal operators, inland carriers, etc. But the transportation of cargo starts with the need to ship it from a consignor, and containers are then sent by to ports by rail, truck, or barge from their inland origins. At port, containers are then loaded onto container ships, and then shipping lines transport these boxes to the required destination using their various shipping network. Once discharged at their destination ports, containers are then moved onwards by any other mode of freight transportation to their final inland destination. The consignor, also known as a shipper, is a person or a company that's responsible for initiating and organizing a shipment. The beneficial cargo owner, or BCO, is the party that ultimately owns the product being shipped. Container shipping companies are the link in the chain that operate the vessels and the containers, and they are the ones responsible for transporting goods at the request of shippers. Now, they can either use their own vessels or charter in vessels from other ship owners. And there are two kinds of ship owners. One is the shipping lines themselves, who own and operate vessels, and another is companies or individuals who own vessels without operating them, and we call those independent ship owners. And those independents are located all over the world, with leading ones clustered in China, Greece, Japan, Germany, Norway, and the United States. Freight forwarders often act as intermediaries. They don't generally operate the transport assets like vessels or containers. They act on behalf of the importers and exporters and offer different services to coordinate with all the other stakeholders involved in the shipment of ocean freight, and that can include booking cargo, organizing the cargo movement, negotiating contract rates, the preparation and processing of relevant shipment documentation. Some integrated freight forwarders can even provide highly valued added services like warehousing or inland transportation. So now that we've covered some of the basics of container shipping, let's now move on to discuss some of the fundamental characteristics of the market and some of the operational structures. Despite its huge contribution to the trade-driven prosperity of the world, liner shipping has not been a big money spinner for most of those that are tasked with shipping the goods that end up in our homes and factories. If we ignore the last few years of the outlier pandemic era, liner profitability has followed a similar or familiar pattern. There's been short periods of acceptable results followed by a return to gloom. There are two major problems that have prevented the industry from breaking this depressing cycle. The biggest problem that gets in the way of sustained carrier profitability is the general acceptance that to survive, carriers must seek economies of scale. And this has very important consequences. Industries characterized by economies of scale tend to suffer from structural overcapacity, and the container shipping industry is no exception to the rule. Until very recently, has been engaged in an arms race for ever larger ships. The second problem is the high degree of fragmentation within the industry, with no shortage of competition on any given trade route. In such a highly competitive market, the seller is a price taker and can have no real individual influence over the market. In this environment, lines will only ever make money when trade volumes grow by chance to such an extent that total capacity is filled. And it's only under those circumstances that the downward pressure on rates is released. So here you can see the typical cycle for container shipping. You start off with a wave of optimism, which breeds appetite for new capacity, which then depresses the market in terms of oversupply, freight rates drop. That then reduces the appetite for new ships, supply and demand realigns, freight rates increase, and then we go again full circle. So what we see is that shipping lines are, or certainly in the past, have been consigned to the same fate as Sisyphus. That is, they roll the stone up the mountain only to stumble just before the summit and descend once more into the depths below. And here's more sort of the characteristics of the industry. Liner shipping is characterized by a number of high barriers to entry. And here we've classified the barriers as either natural or artificial. The natural barriers are high. Economies of scale, again, are vital to the long-term competitiveness, and developing networks, shipping networks, is extremely demanding. Securing vessels and containers has obviously been possible, but it is an expensive business. The artificial barriers are generally moderate to low, the most important being the ability of the established operators to price aggressively to retain their market share, and also the brand image of the established carriers is important. So as we've hopefully established, the container shipping industry is cyclical as the balance between supply and demand fluctuates. It takes time for container shipping companies to respond to the demand changes in the market. For example, the time it takes between placing an order for a container ship new build and the time it takes to deliver that vessel is typically 2 to 3 years. So it's not an instant tap that carriers have. So therefore, it's important for container shipping companies to very closely monitor the trends in the global economy and trade, and to deploy a fleet comprising sort of a combination of owned and long-term, short-term chartered vessels in order to optimize the stability of their fleet whilst maintaining maximum flexibility. And over the past 3 decades, the shipping industry has experienced a number of different cycles. So the industry accelerated in the early 1990s, but then suffered later in the decade due to oversupply and the Asian financial crisis. A new boom occurred in the early 2000s, and that was kickstarted by China entering the World Trade Organization. Predictably, the Great Prosperity attracted too many new vessels to be built in that period. It left the market highly exposed when the global financial crash came, and that pushed many container lines very close to bankruptcy, and in a few cases forced the sale of equity to creditors. During that period, over 10% of the container ship fleet was anchored off duty as carriers desperately sought to bring balance back to the market. Now, in the aftermath of the financial crash up to COVID, the industry fluctuated for almost a decade with relatively modest ups and downs, by today's standards at least. But in general, it was in a trough with balance sheets in need of very serious repair. So that's not to say that carriers haven't tried to change the rules of the game and break out of the entrenched cycle. Partly as a defensive response to the calamitous bankruptcy of Korean carrier Hanjin Shipping in 2016, the industry embarked on a major round of mergers and acquisitions and followed that up with a restructuring of the existing alliance memberships. Theoretically, being a more streamlined and concentrated industry increases carriers' ability to manage capacity closer to demand. And this did appear to be in effect during the early stages of the pandemic, when carriers responded pretty quickly to the anticipated demand crash by pulling ships and services. However, old habits die hard, and the response to the current demand slowdown and overcapacity challenge has been anything but coordinated. In order to benefit from economies of scale, container shipping companies have formed alliances. These allow shipping lines to pool their resources, saving capex and increasing their network coverage. I need to stress they are operational agreements only. They cannot share any commercial information. These alliances that you see in front of you are focused primarily on the core east-west trades, that is to say the Trans-Pacific, Asia-Europe and transatlantic shipping routes, although we have seen them branch out to the Middle East on occasion. The structure of alliances has changed over the past few years, with the latest 3 alliance structure taking effect from April 27. And these are namely the 2M Alliance, the members being Maersk and MSC, the 2 largest carriers in the world. And there is also cooperation on some routes within the 2M with the Israeli carrier Zim. Then we have the Ocean Alliance that consists of CMA CGM, Evergreen, and COSCO, and the Alliance, the members being Hapag-Lloyd, Yangmin, One, and HMM. Recently, the 2M partners, Maersk and MSC, announced that they are not going to extend their agreement beyond its expiry in 2025. Both partners are expected to continue operating as independents outside of any alliance membership. Apart from alliances, vessel sharing and slot swaps are also common cooperation modes used by shipping companies to gain economies of scale and improve the utilization of vessels. A vessel sharing agreement, or VSA, is an agreement between shipping lines to operate a liner service along a specific route using a specified number of vessels. A slot swap agreement is an agreement between shipping lines to exchange a certain number of slots on container vessels deployed again on specific services. And the standard principle applied to all these agreements is that each participating line has an allocation of capacity on each vessel in the shared service equivalent to the capacity it provides to the service as a whole. So, for example, if a line contributes 4 2000 TEU vessels to a service in which 10 2000 TEU vessels are deployed, the line is allocated 40% of the available space on each vessel in the service. Where a line contributes more space than it wishes to use, it's then able to sell space to other participating lines for what we call a slot fee. Each line is typically responsible for the technical management of the vessels it contributes, for voyage management and vessel stowage. Typically, such agreements are governed by a multi-year operating agreement, but if the arrangement simply involves the purchase of vessel capacity from one line to another, it might be much more ad hoc and short term. As mentioned, one of the drivers for change was the collapse of Hanjin and the subsequent mergers that have taken place. And here you can see a list of those. You had China Shipping and COSCO in March 2016, Hapag-Lloyd with UASC in May 2017, Maersk with Hamburg Süd in December 2017. Then you had the formation of the joint venture Ocean Network Express, or ONE, between the three Japanese carriers, MOL, K-Line, and NYK in April 2018. Then we saw COSCO again, this time with OOCL in July 2018. And put together, these transactions have seen nearly half of the top 20 carriers from before 2016 disappear or change guise. And as you can see from this slide, those deals significantly increased the market share based on operational capacity of the major carriers. The top 10 carriers have gone from having around 60% share in 2016 to about 85% today. And moreover, the three leading carriers, all from Europe, are fast approaching 50% share of the market. And here's a quick breakdown of the top 10 carriers by their active fleet size as of July of this year. You can see there are quite distinct tiers, with the leading 4 carriers a good distance away from the middle rung and lower deck carriers. And with their current order books for the likes of MSC, CMA, and COSCO in particular, that is anticipated to remain a trend. Unfortunately, the experiment to see whether M&A and alliance restructuring would push container shipping closer towards oligopoly and a situation where they could sustain profitability was interrupted by COVID-19. All of the traditional rules and characteristics governing container shipping that I've just outlined were simply thrown out when the pandemic arrived. Its influence on the market was so pervasive that whatever state the industry had been in prior, the outcome would have been the same. All of a sudden, all that mattered to shippers was securing space at almost any cost in a container supply chain that was unable to cater for the huge demand surge, not because there weren't enough ships, but because they couldn't operate at anything like full efficiency due to the various delays in ports, and pretty much everywhere else along the supply chain. Ultimately, in our view, carriers lucked into this situation, and it became virtually impossible not to make the incredible profits that we've seen. And here, we outline the various stages of container shipping's response to COVID and the consequences. Initially, in phase one, at the beginning, there was huge confusion and uncertainty, with economists predicting massive trade and economic hardship. The response by carriers was understandably to reduce capacity in order to try and prevent a complete collapse in freight rates. But trade defied the economists' expectation, and consumers spent heavily on the types of durable goods that are moved by containers, as lockdown deprived them of holidays and other services-related expenditure. Fiscal stimulus and e-commerce drove an unprecedented surge in container demand, and that was compounded by retailers forward ordering in order to get ahead of anticipated supply chain disruption and higher costs. The supply chain, ravaged by labor shortages relating to COVID, couldn't meet the new level of demand, and that sent freight rates and carrier profits to extremes. Suddenly, container ship owners and operators were rich beyond their dreams, and Drury estimates that between 2020 and 2022, the industry made a collective EBIT profit of over 500 billion US dollars, and that's almost certainly more than it made in its entire history back to the 1950s. We don't have those financial records, but I'm very confident in saying that. The profit bonanza has been spent in different ways, with some, such as Maersk, using it to further their vertical integration strategies with more acquisitions across the supply chain, while others, such as MSC, have used the cash to boost their shipping fleet. What we did see is that new orders for container ships skyrocketed to record levels in 2021 and have remained very high by historical standards ever since. Now, this is partly due to the industry's decarbonisation ambition, and most of the new orders that we've seen since the beginning of 2022 have been for the alternative fuel types, mostly LNG and methanol, with methanol becoming more of the preferred option of late. However, we haven't seen a clear out or scrapping of the older, more polluting ships. And the reason, so this influx of new ships without clearing out is the root cause of why rates are now falling back to pre-pandemic levels and are in some cases lower. And that's, now this overcapacity situation, combined with the fact that we are now in the end phase with a demand hangover, is the reason we're seeing a very sharp correction in the market. So during that boom, owners bought approximately 7.2 million TEU worth of new container ships in the 2-year window, 2021-22, and that's more than they'd done in the previous 6 years combined. As I said, alternative fuel orders accounted for about half of that spending spree. As I say, that percentage has gone up of late. So it's as if the combination of suddenly becoming enormously cash rich and being faced with a singular challenge, i.e. that of decarbonisation, it galvanized the industry, but at the expense of market supply demand considerations. The recent contracting boom means that as of last month, the order book loomed at 7.5 million TEU, or roughly 28% of the current cellular fleet, which stood at around 26.6 million TEU. Now, for this year, we expect the fleet to increase by 6.1% after accounting for deliveries, slippage, and scrapping. And the gains are going to be of a similar magnitude in 2024 and 2025 at just under 7% next year and just under 5% respectively. And as you know, the key thing to note is that these rates are far in advance of the expected demand growth. So this is going to sink the industry further into overcapacity. Based on our projections, which take into account confirmed orders and their current delivery schedule, slippage, demolitions, and projected new orders by delivery year, we expect the fleet will pass the 30 million TEU barrier in the latter months of 2025. Now, that in itself is not particularly enlightening, but it is the speed at which these new milestones are being ticked off that highlights just how quickly the fleet is growing. It took the industry roughly half a century to reach the first 5 million TEU waypoint in 2001, but then it only took another 6 years to add the next 5 million. And then the respective leaps to 15 million TEU, 20 million TEU, and 25 million TEU were all achieved in shorter intervals of between 4 to 5 years. And if our prediction is correct, the step up from 25 million to 30 million TEU will only have taken about 3.5 years by the time it happens. So you can see the speed at which the fleet is growing is far outpacing that of demand. And that has been the history of the market, but it has certainly accelerated over in more recent times. So in order to make it easier to sort of see the prevailing supply-demand balance, Drewry has developed an index that measures the equilibrium of the market using a range of factors, including obviously fleet and throughput growth, but we also use other inputs such as sailing speed, trade distances, and port productivity. And that is then, you can see that rendered here in our global supply demand index. And to anyone who hasn't seen the index before, 100 represents a perfectly balanced market. If there is a reading over 100, that's positive for carriers, as it means the industry is undersupplied, while a reading below 100 indicates that there is overcapacity in the market. And as you can see from this slide, the industry, or the index, only broke past the 100 line during the pandemic, and only then because port productivity was so poor relative to before the pandemic. And I think this emphasizes that it was nothing that carriers did. They were simply the lucky beneficiaries. Now that the market is normalizing, those market fundamentals that I outlined earlier are back in play, and they are going to work against carriers unless they take much more significant action to cut capacity. Since the peak earnings of 2Q22, when the industry's profit margin topped out at an incredible 55%, carrier profits have been trending down, and this was reconfirmed by the financials in the first quarter of this year. The industry delivered an estimated EBIT margin of around 20%, and now that followed performances of 35% in 4Q22, 51 in 3Q22. We estimate that carriers made a collective profit of around $17 billion in the first quarter of this year. Now, that's still a level of profitability far in excess of anything seen before the pandemic, but there isn't any real cheer because the direction of travel is obvious to everyone. Container lines know that these results are the last embers of their red-hot super cycle. And for this year, we've maintained our industry EBIT outlook at around 15 billion. That assumes that gains that are made in the first half of the year are not going to be totally eaten up by losses in the second half. But we are much more pessimistic for carrier prospects next year, and that follows on from a significant downgrade to our freight rate outlook. We now think that average freight rates, that is to say spot and contract combined across all trades worldwide, is going to slide by around 1/3 next year, and that follows an anticipated crash of 61% this year. Weak demand, overcapacity, and predatory pricing by some carriers is the rationale behind our expectation for lower rates. So as such, we have lowered our 2024 profitability forecast to losses of 20 billion at the EBIT level next year, and that's down from what we had predicted minus 10 billion back in March. Even allowing for leaner years ahead, there is no immediate bankruptcy risk to carriers. Cash reserves are still plentiful, but the mountain of cash is going to look more like a hill soon, especially if carriers don't tackle the overcapacity challenge, and if they want to continue pursuing strategic acquisitions as well as upgrading their assets to meet their decarbonization targets. This slide provides a quick summary of the various market threats as we see them. One that I'm going to focus on today is carrier behavior that you see at the top. Now that's a constant wild card to our forecasts, but it is one that took on much greater prominence in our latest container forecaster. Until recently, we were anticipating much stronger capacity interventions by carriers once their profitability was jeopardized. But we're now seeing that changes to the alliance structure and behavior to date has kind of flipped our view. Given that the price of inaction is for average pricing to fall below 2016 levels by next year, this could prompt more preventative corrective action. But we think given strong balance sheets and in the upcoming alliance restructuring, we think the probability of this happening is fairly low in our view. Now, a few carriers and shippers want this race to the bottom on freight rates to end so that liner services aren't jeopardized. Recently, Hapag-Lloyd CEO warned that the erosion of freight rates to a cash negative position would result in some service suspensions. And certainly a side effect of the pandemic is that many shippers are now prioritizing the surety of capacity and service reliability over costs. A number of BCOs have told us that they too would prefer more sustainable pricing from carriers in order to reduce the risk of flash disruptions to liner networks. But I don't really think this is realistic in a falling market. I think we will see less haggling over marginal shifts in pricing. But as BCO cost pressures resurface, we think it's unlikely that any are going to turn down more significant rate reductions when they're available. And with scarcer cargo to fill the growing armada of new ships, we expect carriers to price services to win business from weaker competitors. And this approach to pricing and market share ambitions is going to vary. The likes of MSC are building volume to prepare for life outside of 2M, while others such as Zim and Maersk seem quite prepared to lose market share. But inevitably, the actions of the predatory carriers is going to weaken the market, offsetting the impact of other carrier attempts to stabilize it. Inevitably, those predatory carriers will dominate and take control. Okay, that is all from me. Thank you for taking the time to listen. I hope you found it useful. Goodbye.
Okay, thank you, Simon. So, from his presentation, we do find that Simon is a veteran in the market. He has extensive knowledge of the shipping industry, not only about what is going on now, but also about what has happened before. So, thanks again, Simon. The next speaker is Mr. Xiao Kun, Senior Manager of Futures Derivatives Department at Shanghai Futures Exchange and Shanghai International Energy Exchange. He is also a registered financial risk manager. He obtained his bachelor's in computer science and master's in financial engineering from the United States. He worked also as an algorithmic trader from the hedge funds in New York before joining Shanghai's exchange in 2014. Currently, he is mainly responsible for the research and development of commodity index funds and index derivatives. In 2015, he developed UBS SDIC Silver Futures Loft product, which won the Shanghai Financial Innovation second prize. In 2016, he developed the Sheffield Commodity Index series, and the project also won the second prize of Shanghai Financial Innovation. So much said. So now let's welcome Xiao Kun and listen to his presentation about the contract.
Ladies and gentlemen, good afternoon. I'm from Sheffield. I'm from the derivatives department. My name is Xiao Kun. I'm really honored to be able to present to you our product that we designed. Actually, it's the draft plan of the product, and also I will be presenting to you the rules of the product. Very much many thanks to your attention to the product. Well, we fully implement the instructions of the 20th Party Congress of CPC to service to China's initiative to become a strong marine country, and the contract is for the purpose of improving the allocation of shipping resources after its listing, while helping the financial sector to contribute to the management. And shipping index is rather innovative. So at the very early stage, we have done a lot of research, including the research about its risk control measures, as well as the design of the contract specifications. In particular, we've gone through the pandemic of 2020 to 2022, characterized by tight supply and the tight supply chain, as well as the vicissitudes in the market. In this process, we have had a solid start while always benchmarking against a high standard in designing the contract. So without further ado, I'm going to walk you through the product as well as some of the specifics of the product. Well, in terms of the needs of the industry, while the container industry suffers from the high fixed cost, including capex investment, which is huge, and every ship is built at huge cost, whereas its ROE is rather low, and the freight rates tend to fluctuate a lot. So this futures product can help the industry, for example, locking in the risk of the fluctuations of the freight risk and thereby locking in the profits. So we think that the product can serve the entire industry. Thirdly, from the perspective of Shanghai, internationally speaking, some famous cities are characterized by very advanced shipping industry, including London, New York, and Singapore. They all have sophisticated shipping industry supported by sophisticated derivatives, both OTC products as well as exchange-based products. The same applies to Shanghai. So going forward with the listing of the product, Shanghai as a whole can better serve the shipping sector. Fourthly, again, in terms of improving the level of financial services, as we are going to list the container freight index futures of European services. Firstly, it's going to be a derivatives that's exchange traded, and the second is characterized by cash settlement, and thirdly, it means that with cash settlement, you don't have to do physical delivery. In other words, it helps you lock in risks. And then I would like to walk you through the design of the EC contract. Firstly, the product itself is characterized by the fact that it's traded on the international platform, is characterized by cash settlement, and it is a index futures that's denominated in RMB. The product, again, is characterized by the fact that it's listed on INE, which is an international platform, and INE collaborates with Shanghai Shipping Exchange. We adopt their settlement price or their settlement rate to develop the product. Settlement method is cash settlement, and the product is open to international investors both in and out of China. It's denominated in RMB, whereas we also accept USD as margin. So that's pretty much the general design of the product. And the underlying index is Shanghai Containerized Freight Index, which is a spot index and is based on settled rates, which is different from the traditional way of or the traditional quotation rates. Basically, it's based on actual settled rates. The index is based on actual settled rates, which we believe to be rather trustworthy. The index is characterized by the fact that it's being audited by PwC and is also audited or is also recognized by IOSCO. In addition to that, it's the shipping line from Shanghai to Europe, and the index is published every week on Monday. The settled rate is gathered from 10 shipping lines as well as 4 freight forwarders by integrating with their API data, and compilation of the index is done in this way. The index again is published every week on Monday on the website of Shanghai Shipping Exchange, and it's open to every investor. So here you see the basic specification of the contract, including the underlying being index, and the contract multiplier is 50 yuan per point, and the price quotation is index point. The minimum price fluctuation is 0.1 index point. And in terms of listed contracts, we adopt the month of February, April, June, August, October, and December. By adopting the month of February, April, June, August, October, and December, we think that will contribute to a solid start because that will help aggregate the liquidity of the contracts. And in addition to that, all these months present the months where container activities tend to be very active. For example, August and December are both peak seasons for container shipping, whereas April and August tend to be low season. In other words, we cover both peak seasons as well as low seasons. The trading hours start from 9 to 11:30 a.m. and 1:30 to 3 p.m. Beijing hours. We don't offer nighttime trading. In terms of the daily price limit, the daily price limit is up or down 10% of the settlement price of the preceding trading day. Minimum trading margin 12% of the contract value. Last trading day is the last futures trading Monday of the delivery month, as we think that this happens to be the day when Shanghai Shipping Exchange publishes its index. As a result, we determine on the day as the last trading day, which is the same as the delivery day. The settlement type is cash settlement, and product symbol is EC or European Container, and listing platform is INE. Specifically, as you can see from these charts, very much there are a lot of specific details of the contract. 50 yuan per point is the contract multiplier. At the highest is around 9,000 points. In other words, it's equivalent to 480,000 RMB. during its peak, and currently the freight has gone down to 780 points currently, which is equivalent to around 39,000 RMB. So from this, you can see the freight fluctuations, in particular over the past 2 years, tend to be very dramatic, with the highest point being 9,700 and more, and the current level being a mere 780 points, which represent dramatic fluctuation out of all the commodities in the spot market. So we have taken a variety of measures in order to mitigate and to fend off relevant risks. The contract player multiplier offers you very detailed reason why we have determined on the figure of 50 yuan per point. We believe it is an appropriate figure, not too high nor too low. But with the point going up, the contract value goes up as well. In the shipping market, as well as basically 2 TEU on average is the operating common carrier's book capacity. In other words, one lot of EC contract is enough for hedging, which means that for smaller companies as well as freight forwarders, it's rather easy for them to engage in trading. In the same time, for larger liner companies as well as larger shippers, we offer them the possibility of larger positions, and 50 yuan per point also satisfies their need for hedging in big quantities. The minimum price fluctuation is 0.1 index point, which is in line with the characteristics of the spot freight rate index. As the spot's minimum price fluctuation is 0.01, so we think that for futures, 0.1 index point is more appropriate, as it's neither too large nor too small, and it rather accurately captures the changes of the futures or the index change. As I mentioned, that the contract month covers April,
Regarding
February,
listed contracts
August.
and listed months, it's usually even number. So we have factored in the capability for existing contracts to be traded more proactively and other factors as well. We also refer to internationally traded index futures. Usually they are going to be listed for every even month or like 3 months on a rolling basis or something, no matter which way you look at, no matter which one you refer to. Basically, the rationale behind the design for the listed contracts is the same. So to make sure that, thirdly, we can understand that the shipping market is different from commodity market. So we are a service market, right? So based on the nature of a service market, we have to hedge against a lot of delivery risks thanks to the volatility nature of the market. So that's why, based on the 3 considerations I mentioned before, to concentrate liquidity, increasing the trading activities, and second one referring to international one, the third one, we are listing it every even month, even numbered months. But when the time is right, we are going to adjust it. Maybe when we have a better fit for the market, trading hours is between 9 a.m. to 11:30, and also 1:30 to 3 p.m. So that's the current design trading hours for our new product. So this is about the price limit and price upper limit and price down limit, etc. Based on our historical track record, or like the calculation of the traditional like a slot fixing pricings, as well as the past movement of the freight rate over the past 15 years. We hold a view that, generally speaking, for shipping industry, so think about the volatility is usually very frequently happening. But ever since the formation of the 3 alliances is less volatile than before, so we think that a 10% daily price limit is going to be the right level. So 10 and day 2, 13% and 15% can cover about 43% coverage of consecutive price limit is in either direction, and it can cover 96.79% of the historical price movement. So that's why in the written contract we designed the price limit to be 10%. So think about the price limit is tentatively set to be 20% for the last trading day. Why? It's because the convergence of the futures price versus the spot price market, so that we are going to to give more room for the spot index to swing across a wider range. So that's why on the last trading day is 20%. Well, in terms of margin, so we are trying to use a time-graded way to set up the margin. So since the day of listing, it's a minimum trading margin for EC contract of 12%, but ever since the seventh trading day prior to the last trading day, so it's going to be cranked up by several notches to 20% trading margin. And as of the second trading day before the last trading day, so the margin ratio is going to be 30% or something. So the purpose of us designing it this way is because close to the delivery date in the market, there will be some bargaining place and pro and cons. So close to the delivery day, generally speaking, if in the spot market for the delivery of the underlying assets in the spot market, if the freight rate is going to skyrocket, usually 50% or 100% shooting up or increase of freight rate. So I think that will be a valid risk. So we have to cover that major risk. So that's why closer to the last trading day, close to the delivery day, so the second trading day is going to have a higher margin being deposited in order to hedge against the market risks. Well, this is something I said before. So it's a cash delivery settlement. So it's going to be transacted at INE. Before I conclude, I would like to walk you through some of our trading rules as well as our trading businesses. Well, please refer to this one. So think about the listed category. It's going to be listed in INE. So for onshore investors, domestic investors, compared with other available for trading onshore products, it's the same thing. So domestic futures firm members is going to be the one between you and the one who can connect to INE. So overseas clients can directly use the domestic FF members or use the overseas intermediary companies as the bridge to connect you with domestic FF members, or trying to use like the OSBP, the overseas special brokerage participants as well. So there are different ways for the overseas clients to access our domestically tradable product. So this is about investor eligibility criteria. So the point about setting the eligibility criteria is for the benefit of the ones who are not that experienced, like retail investors. If you really want to open up your account, you have to meet the full screening criteria before you can do it. First of all, we're going to test you on your basic knowledge. So after you pass the test on your basic knowledge, we're going to look at your trading experience, your track record. On the mock trades, you can do some practices or exercises as well. And for other available for trading internationally listed brands, which is onshore here in China, which is open to international investors. If you have previous trading track record, maybe you can qualify for that. Available funds should be more than 100,000 RMB yuan, no less than 100,000 RMB yuan. So that's the threshold for the minimum daily available balance before you can qualify for trading this. And also internal control for institutional investors, like risk management measures and others. You have to put in place the institutional rules and arrangement and framework before you can qualify for investing in the newly listed products so that you can prevent against potential risks. Well, we have specially designed a market making mechanism called a market maker. So initially, when we first launched this product, we are going to increase the market liquidity and proportion of institutional investors by introducing the market making mechanism. So there will be like the price spread between the buy and sell, and there will be quotation. And so this is going to stabilize the operation of the market. And so after the official announcement from the CSRC, we're going to screen for who are the qualified market makers. And so there will be all different types of qualified applicants who are going to file their submissions and applications with us. And then we're going to screen you based on our eligibility criteria so that the chosen one, the shortlisted one, will be the final market makers. Well, in terms of our trading orders, well, it's still the traditional limit order. We have two types of them, limit order FOK, FAK as well. So the trading hours between 9 to 10:15, followed by a 15-minute break. Same thing compared with the other different tradable categories. And the trading session reconvene at 10:30 and lasts for 1 hour. And also the afternoon trading hour is about 1:30 to 3. So the daytime trading session it's closed for now because it's the initial launch period. We're going to have a watch and see kind of attitude to see if there is any uncertainty and risks. And there is a position for the minimum order size. So one lot is the minimum one. A maximum order size would be 500 lots. That is to say that if you place a single order in order to prevent against risk escalation, we're going to limit the maximum lot size by 500 lots. What about hedging and arbitrage? Well, if you are a spot trader, if you really want to participate in trading for the futures market, I would like to let you know that for China's onshore market, there is a position limit, of which over a certain threshold position limit, you cannot open new position. If you still want to open new position, you have to fulfill any additional requirement and standards. So think operational position of your spot, you have to present a record to us. In addition to that, so in case operational position is very high, if you have such a need, and you can file for the application for filing for the quota for hedging and arbitraging. So after we got your hedging quota application, we are going to screen you for if you are qualified for that. So you'll find that actually for the regular months, like application for hedging quota, it could be, the application could be filed between the listing day of the contract and the 8th trading day before the last trading day of the contract. So actually, before that deadline, if you can file in your application in that time window, you can get application for the quota. And for the nearby months, how do we define it? The nearby months is defined as, so you'll find that actually, so the first trading day in the month prior to the delivery months until the 5th trading day before the last trading day of the contract. So that's the time window for you to file for application for hedging quota for arbitrage quota for nearby delivery months. So you find that you have to use that within the certain prescribed time. So closer to the nearby months, you can see some details on this chart so that you have a clearer picture of what I mean. So closer to the delivery months, you'll find that actually within the 8th trading day, so the regular months is usually from the listing to the 8th trading day before the last trading day. That's the difference. A nearby months is the first trading day of the month prior to the delivery months to the 5th trading day before the last trading day. So this is different from actually the traditional one. So the traditional categories, the last one is the last trading months, but for our futures is actually the last 8 days, because it's kind of an indexed bond, like a trading mechanism, so that you can use that for longer. Well, the fourth one, I'm going to walk you through some clearing and the settlement business of ours. So the settlement currency is RMB. Well, still cash settlement is the settlement method. So margin rules. So there are two parts of that. The first one is a trading margin. This is like the targeting the clients, while the clearing deposit is targeting the members. So we are using mark-to-market, daily mark-to-market mechanism as well. So you find that for the initial period since the launch, we don't open the larger side margining. It's not offered for the initial launch of AEC across different months. So we wouldn't give you a discount for the margin. The reason we designed it this way is to hedge against, prevent against risk, because containerization type of shipping is kind of volatile based on the market need and demand. So across different time of the market, you find that sometimes the freight rate is not totally directly correlated with the demand or something. It's different from like brick and mortar physical goods, because physical goods and commodities could be stored in the warehouse. There will be incurred a warehousing fee, but for container shipping across different months, there is no correlation amongst them. So that's to say that, so you find that for the next week and for the next 2 following weeks, so my slot available is not going to have any bearing for the slots available for the next few months or weeks. So across different contracts, we believe that the correlation is not as strong as if they are between different commodities. So for initial period of the product launch, larger side margining is not going to be opened. Well, the final settlement price is designed as a very important feature of our products. So the way we design it is just like, so the arithmetic mean value of like the 3 different target indexes on the last trading day of the contract and the first and second index publication days before the last trading day, you can refer to the details. So we are trying to look at where the spot index is at for the 3 ones, and then try to arrive at its mean value, and then trying to use that as a final settlement price. The beauty about this one is to make sure that we can reduce our exposure to to the single weekly price fluctuation. At the same time, we can prevent against the overweighting of a single monthly index. Well, for based on like a foreign comparable products, just like a dry bulk, futures, etc. Let's take that as one example. Usually, they're trying to look at the monthly average price of delivery months. That's the final settlement price. So that's why before we set up the final settlement price, we factor in those different considerations. So the way we set up the pricing is in line with the market trend in the international standard with the international standards. Well, last but not least, how you can open up your account. So what about the procedures and what about the custodian depository banks? Domestic bank account is something you must have, and FF account so is in between. So it's in between between the domestic bank account versus the trading of INE's futures product. And for the foreigners, so you are using the overseas bank account through NRA non-resident account. So this is a specialized, the exclusive account dedicated for each different overseas institutional investor. Everyone will have a dedicated exclusive NRA to yourself, and you can wire through the futures firm account here in China, and so that you can access the trading of INE futures product. For overseas investors, you can use RMB or US dollar as the margin deposit. But the profit and loss could be covered only by RMB. So between NRA and overseas accounts, so there is a cap level for the maximum of fund transfer you can transfer between NRA and overseas accounts. And overseas investors may choose to receive investment profit in RMB or US dollars. The profit currency will be changed every 6 months, and foreign exchange is only limited to the amount of investment profit and loss. Well, these are some of the designated depository bank. So domestically, so we have the 12 banks designated as depository banks and plus 10 overseas banks as depository banks. And the 9 banks in the middle can both become like domestic service providers, or overseas investors can get your service here. So because they can do both. Well, given the fluctuation nature, volatility nature of containerized shipping freight rate, so for the underlying index and futures alike, we have a very stringent risk control design. So think about the underlying index. We have to make sure that the agency in charge of compilation of the index must factor in all the risk features of the index to make it risk resilient. At the same time, it must be transparent, scientifically advised way to do the index compilation, and the management of the index as well as contingency measures will be improved. At the same time, for the IOSCO, which is the International Alliance for the Securities Commission of different countries, have already approved that.
And also, INE uses price limits, position limit, margin, as well as the design of the contract, large position reporting, as well as the warning system to prevent such risks of major fluctuations of this product. So here you see the minimum trading margin requirement as what I've already introduced. We did historical calculation, and according to our calculation, 12% is basically enough to cover 100% of 3-week average price movement, and 20% and 30% are basically enough to achieve 100% coverage. Also, we considered the fact that the price limit and the price limit at the initial period of listing is designed as 10%, whereas the figure is 20% on the last trading day. However, during regular trading, when we see continuous single-side market, we adopt the method of +3 and +2. In other words, when we see up 10%, when we see a price limit on day 1, then it's 10%, on day 2, 12%, and day 3, 13%. That's how we design the price limit. And here you see the position limit of the contract. The position limit is executed to prevent any single client from holding too much or too large a position on a very specific contract to prevent relevant risks. And according to our calculation of the shipping between Shanghai and Europe, and we convert it into monthly average volume, while also taking into consideration of the proportion of spot companies who need hedging at about 30 to 40%. And we have taken into consideration all these things to calculate their position needs on a monthly basis, and therefore we designed the position limit system basically for general clients. As of the listing of the contract to the 8th trading day, before the last trading day, they have about 1,200 lots at around 60 million RMB in absolute limit terms. And in the last 7 trading days, the number will go down to 360 lots. And during the last 2 trading days, the number will further go down to 120 lots at around 5 million RMB. So we believe that with such a tiered position limit stipulation, we can achieve utmost in the utmost level, reduce the risks, and we encourage people to trade contracts that are farther way out in further months. And here you see responses to limit locked market. When we see a limit locked market, the price limit as well as margin will be subject to improvement. And also during the last 5 trading days, if the index market see major way up, say major fluctuations up or down, then we allow for the time limit market during the last 5 trading days without taking any emergency responses, such as suspension of the trading of the contract, for the purpose of letting the market release the risks at the utmost extent, whereas we also charge margin at a high level. But this slide shows you special responses to large cumulative price changes over 3, 4, or 5 consecutive trading days. So if the spot market has major fluctuations, whereas on the futures market side, we don't see limit up or limit down. However, we do see large cumulative price changes over 3, 4, or 5 consecutive trading days at 18%, 24%, and 30% respectively. INE can adopt various measures in accordance with Article 9 of the INE Risk Management Rules. Measures include the following. Firstly, INE may require additional trading margins from some or all of its members and/or OSPs on either long positions, short positions, or both, or at the same or different margin limit rates. They can also limit the withdrawal of funds by some or all of its members. INE can also suspend opening of new positions by some or all of its members and/or OSPs and adjust the price limit, but not over 20% up or down following the adjustment. All these are taken to prevent risk to investors as a result of major fluctuations, either on the spot market or on the futures market. Thank you very much. So much from me.
Okay, thank you, Xiaokun, for the introduction. And Xiaokun participated in the design of the new contract, so he is the best one to answer your questions. The next session will be from Mr. Xiaoyu Chen, Vice President of International Department of Nanhua Futures. Xiaoyu is experienced in Chinese derivatives market, responsible for overseas intermediary and QV business development, as well as cross-border asset management. Serving a wide range of corporate clients globally, he has acquired enough experience with providing professional inbounding solutions, advisory in both offshore fund management and executing onshore domestic Chinese futures as well. So now I would like to welcome Xiaoyu for the presentation.
All right, thank you very much, Liping. And hello, everyone. This is Xiaoyu, representing International Department of Nanhua Futures. First, great honor to be invited by Sheffy, who's putting a lot of effort preparing for the upcoming new product, Containerized Freight Index futures. Well, since they have been given enough color on the product itself, I would just jump right into the reason why China market is so attractive, how people can access it, as well as the uniqueness about it, to be in line with my topic today, the final frontier for alpha. So, as we know, China is one of the last non-institutionalized market in the world. Well, until now, the retail investors are still dominating the Asia market. Well, the retail participation is definitely lower in the commodities space comparing to equities, but still, higher than average. So it's viewed by many foreign investors as the final frontier for alpha. From another angle to look at is, as the second largest economy by GDP, we have seen enormous economic growth over the last 20 to 30 years. And this sort of growth has translated to our financial and commodities market, especially when it comes to liquidity and trading volume. And so sharing some Greek graphics from IFIA website, as you can see, the blue line is Asia trading volume in the futures space. Not hard to see Asian volume surpassed other areas in the world by 2009, and also from there experienced a rapid growth since 2014, recording an 11 billion lots record in 22. And even in 2023, this year, if we look at the table underneath, to me, it seems like the growth of trading volume in China futures market is kind of like the most important reason to support the rapid growth of trading volume in Asian markets. And if we take a closer look at the China market, these bars on the left is the aggregate trading volume among China exchange. So if we compare to the volume by region table, we can find out this exact same trend as the China trading volume. And among all exchange traded products, metals and agricultural products contribute, the most in terms of trading volume, which, is a common sense given China's rapid development in recent years has really benefited from the rise of infrastructure construction and the real estate industry. And also, as you know, China has a large population base, so there will be large agricultural import and export demand. And in the ranking of global trading volume of metals, agricultural and energy products in 22, onshore products occupy the top 10 of agricultural products, accounting for 16 seats in the top 20. And for metals, onshore products occupy 9 seats in the top 10 and 14 in top 20. In terms of energy products, onshore products occupy 5 seats in the top 20. So another interesting finding about it is among the top traded products in the table right there, almost everything are accessible from offshore via existing market access, such as internationalized futures, Q fees, or TRS. So how we can access China market from offshore, right? And what products are feasible exactly, and what are the requirements and terms, blah, blah, blah. So previously, without setting an onshore entity, foreign investors could only invest in stock index futures under the previous Q fee scheme, and a few more specific types of commodity futures available for direct investment by offshore, such as INE crude oil, TSR20, iron ore, bound in the Cooper PTA, and etc. But under the new Q fee measures implemented in late last year, a large variety of commodities futures as well as financial futures were eventually, also became available to foreign investors for investment. So till now, there are multiple pathways offshore investors could choose from based on their own preference. Okay, so let's take a look at those. So on the very top, road A, the fastest and I would say easiest way to access is via internationalized futures. Clients can set up a counterparty relationship with one of the overseas intermediaries and access these products just like they access any other markets, right? And in fact, there are already quite a few offshore brokers, I believe, who can provide this kind of services. And besides, client can also trade with onshore brokers directly if they have a non-resident bank account in place for cash settlement. As you know, exchanges are keeping expanding their offerings. There are a total of 14 futures and 9 options as internationalized ones for now, which have been largely traded by overseas corporate and institutional clients. And underneath that is row B, which is the QFII mechanism. After the new QFII measures, clients are able to access to multiple asset classes via this scheme, including stocks, interband bond market, exchange bond market, 23 futures options. 23 futures and 16 options, financial futures, as well as allocating in mutual fund and private fund. So this QFII scheme, mechanism has actually been up and running for more than 2 decades, and it is heavily used by asset managers and pension funds, foreign fund management firms, as well as investment banks. And if I can recall, until May of 2023, this year, there are a total of about 760 something QFII license holder, and this number is still growing. And it's also interesting to know that there are more than 200 applicants who received this qualification over the past 2 years. And underneath that is row C and D. Well, say basically saying overseas clients can also get access to China A shares via China Connect and futures options via TRS brokers. And D, for those who are interested in physical operations and local presence in China, they can also do so by setting up a physical office, so-called WUFI, wholly owned by foreign enterprises, which allow them to have full market access to the China financial market, no difference from any other local companies down here. But not many would choose this option, considering the taxation and legal status. But that's pretty much all the options are out there right now. And among these options, most clients would choose to trade internationalized futures or trade via QFII. So let's compare the product offerings under the both. First, we can see there is a great similarity between the two, especially on DCE and INE, and iron ore options, PTA options, methanol, white sugar are only accessible via QFII, versus rapeseed meal and peanut are only accessible under internationalized futures. So the biggest difference appears on SHFI, that metals, such as gold, silver, zinc, aluminum, can only be accessed via QFII for now. But as containerized freight index futures launched, we can look forward to seeing more metals products to be added to this category. And for those who want to deliver or take delivery, to or from exchange, please be aware that this is not allowed for QFIIs to participate in the physical delivery process of futures, just simply due to the fact they are not able to issue or receive value-added taxes invoices, which is a must of such kind of delivery process. And once getting involved in the physical delivery, QFIIs would be at a risk of And for your information, there are 6 internationalized products can be delivered by offshore right now, including all INE products, Dali iron ore and Zhengzhou PTA futures. And also, clients must apply, standard warehouse system account in order to register warehouse receipt and submit delivery application and stuff. And on top of it, whoever wants to take delivery should be fully aware of the timing requirement. For example, the warehouse receipt has to be registered 3 days, I think, prior to the last trading day, and etc. So please, consult with your brokers on this to avoid any violations. So after comparing the product list, let's take a look at the entry threshold for both. So to participate in internationalized futures via overseas intermediary, the client needs to fulfill certain, funding requirements and investment experience, like the previous speaker just mentioned. Well, these requirements and experience are quite easy and straightforward for most clients. For example, the highest funding requirements is to have no less than million RMB excess cash for 5 days to trade crude oil. But other than that, for all the other products trading, the excess cash requirement drops to 100K RMB excess cash. When clients wants to trade directly with onshore brokers, like I just mentioned, yes, entry threshold are totally the same, but plus a non-resident bank account is a must. Okay, so addition to that, offshore brokers can also play a role as as overseas intermediary by applying it via onshore broker. So first, there are some criteria have to be met, and the broker's jurisdiction has to be approved by China regulators. Then there is a minimum net asset value in terms of operation requirements. So right now, there are more than 100 offshore brokers spreading over 11 or 12 countries have got this qualification. And we're definitely excited to see more areas to participate in China market. Okay, so compared to internationalized futures, the entry threshold for QFII applicants will be a bit higher. And basically, the applicants need to have at least 2 years of investment experience and minimum of 10 million RMB net asset value, and some other financial indicators requirements. And most importantly, the proper asset under management has to more than 100 million RMB, which that one seems to be like a challenge for some small medium-sized asset managers. And when you met these requirements, you should definitely reach a custodian bank to help you with the application. And because the custodian bank also, they are quite essential in the whole process of your QFII investment, because they are highly engaged in every single part of it, such as funding, fund out, valuation, reconciliation, auditing, as well as tax clearance. And speaking of which, almost everyone are curious about the QFII tax policy. Well, it's a given that QFIIs are exempted from value-added taxes, but there's not yet have clear rules about it, whether the profit generated in the futures market by QFII will apply to capital gain tax, or what kind of percentage will be applied. So on this basis, some QFIIs would consistently remain or keep 10% of the profit in their custodian bank, which the 10% seems to be believed at the top number. And just in case there is clear policy that requires traceability of past profits. But it's always beneficial to chat with your custodian bank and your service providers in case they have different takes, different angles and considerations on this. Okay, so in this part, I would like to introduce some unique policies and practices of China futures market. Well, these rules are quite, some kind of different from other markets, and usually we'll spend a great deal of time to explain to our clients. So first, this so-called one code per client policy. Well, it's kind of Chinglish, but what that means is for each entity or each individual, they shall have and only have a unique trading code within the exchange. So, for example, if I am trading Sheffield, for example, via three different brokers, let's say, and on the exchange level, they're actually able to see all these trades are done by myself, and I'm actually the automated beneficial owner behind these three separate accounts. So unlike the offshore market where all clients' money and all clients' account are mixed up in the broker's client account, the offshore exchange can only detect the large positions holder by receiving the large position notice voluntarily submitted by different brokers, right? So this one code per client policy has been really a great practice from a risk management perspective, because the position limit, the trade limit of the entity are accurately calculated, so the risks are perfectly monitored, I would say. And another point is regarding the trading model. Well, in China, the agency model is adopted in relation to futures trading instead of principal to principal model, which has been heavily used in many European markets. Under this agency model, the broker will be acting as the agency for the exchange. And as such, the fund manager's counterparty will be the exchange itself instead of the broker. So the broker will be acting as an agent on behalf of his client, with the exchange acting as the central clearing counterparty as well as their trade counterparty. So on this basis, the counterparty's defaulting risk will be significantly lower, right? Additionally, as per the futures agreement, onshore brokers would normally would like to keep the rights and have the rights to initiate forced liquidations under certain market conditions. Usually, the broker will close out a portion of the positions if the risk rate, so-called risk rate, drift above a certain percentage. And in some extreme market conditions, the brokers will want the right to make forced liquidation so as to lower and restore the risk degree to below certain percentage. But brokers will always notify the client first and raise red flags about the risk status, and of course give client enough time to respond to a margin call before the forced liquidation is triggered. So that's that. And regarding margin policy, in China, margin is generally posted as collateral. So sufficient margin has to be posted prior to, not after a trade takes place. So the amount of margin that is required to be posted to the margin account is kind of subject to negotiations. So many clients can post exchange standard margin, but of course keeping some excess cash in account to stay away from margin call and stuff. Other than these uniqueness, the clients should also be aware of other rules such as fat finger numbers, right, and order fee collections, and also the order type difference, like close order and close today order when they trade on Sheffield. Okay, so a quick intro of the firm before I hand over to the host. The company was founded back in '96, one of the oldest FCMs in China, with more than 25 years development. We have witnessed a lot of up and downs on the market, and we provide comprehensive financial services to our partners, clients, using our in-house infrastructures and qualifications. And we do have multiple subsidiaries in different locations in the world, including our UK, Chicago, Singapore, and Hong Kong office, and of course with multiple clearing memberships. So in this case, we're fully covered in terms of market access and also allowing us to provide comprehensive services in the clearing space. Yep. So last but not least, if you have any questions or inquiries, please feel free to get in touch. Here is a QR code from my personal WeChat and WhatsApp with my contact information underneath. You could also follow us follow our company on LinkedIn, YouTube to browse our latest events, research, and news. Okay, so that's pretty much everything I would like to share with you guys today. Thanks again to Sheffy and Yiping for organizing this event. Really honored to be here. Okay, so look forward to seeing you again in the future, and back to you, host.
Okay, thank you, Xiaoyu, for the great presentation and introduction. So that's all for today's content. And if you would like to receive more information on the upcoming events, or if you want to receive the monthly statistics that INE sends out, please feel free to scan the QR code on the screen and subscribe to our mailing list. Thank you very much again, and see you next time.